Investment Committee meeting, and we have one more presentation from Makita. So you're on.
Great. Steve McCourt with Makita Investment Group, here with Lisa Bacon from Makita Investment Group, who does the bulk of the work for us on this assignment. And in the interest of time, I'm just going to hand it over to Lisa to review our 6-month evaluation.
Thank you, Steve. Lisa Bacon, Makita Investment Group. So starting with performance, as I got to report last time and the time before, the infrastructure program continues to outperform its benchmark. The absolute returns are impressive, and the overperformance relative to the benchmark also is. On the first page of our letter to you, we've got a table showing what the performance is. Even though this is the 6-month reporting period and sometimes we cover the year, I really would direct your attention more to the 3, 5, and 10-year. Infrastructure obviously is a longer tenured asset class, and so while the earlier performances are important, and your eye is probably particularly drawn to the 20% for the 1 year, which is nice and healthy. The other years are really more representative of what the asset class is built to do in your portfolio. In terms of a couple performance highlights across the portfolio, we looked at some of the diversification parameters. And so with respect to risk and return, core really has been the strongest. It's a story that you've heard within the real estate program as well. It's a good time for that, particularly for that asset class. Within that, the international portion of core also has been particularly important. With respect to the segments, international is one of your segments as well. It's delivered very strong returns and has really consistently been at the top across longer periods of time. Commercial and power, the segments have been essentially at or a little bit above their targets, whereas the specialized category, which includes the value add and the opportunistic risk return profiles, have lagged somewhat. With respect to income and appreciation, the portfolio tilted towards core is really built to capture more of the total return from income, and the yield over the past 6 months has been 6%, which is where you're shooting for. This is up from prior periods and reflects, I think, the maturation of some of the assets in the portfolio. With respect to key program parameters, your NAV as of March was at $4.2 billion, which is an increase of $250 million or 6% compared to the September numbers of the prior period. And this NAV represents 1.2% of the total fund, which is a little bit above the interim target of 1%. With respect to the policy ranges that are laid out, the risk categories, core, value add, opportunistic, all of those are in compliance with those ranges. With respect to the regional distribution, diversification targets and limits, those are all within range. Your leverage and your external manager metrics are within the policy ranges, and we've reported here on segments which are not measured for policy purposes at the infrastructure program level, but at the real asset program level. Still, we want to keep track of the diversification there, and as you can see with commercial, essential, international, and specialized, those are diversified within the portfolio. Moving on to a little bit on market commentary. As you've heard in some of the other sectors, the deal volume continues to be high, the dry powder continues to be high, and so it really is an active market, which is good for valuations and is part of the reason why you're seeing that 20% for the short-term period, but it also makes deploying capital at the kind of scale and with the kind of quality that you're looking for a little bit difficult. With respect to where the deals are being reported, Europe is dominating the data that we have. Some of that has to do with there's a lot of activity in Europe, and some of it I think has to do with who reports and where the data are available. But North America certainly is a very significant source of deal flow, racking up $28 billion in the first half of 2018. With respect to sectors, we're seeing a lot of diversity there as well, covering energy, renewables, transportation, power, and midstream are all very meaningful portions of the deal flow over the reporting period. Social waste and water were much smaller segments, reflecting less availability, more fragmentation, a smaller kind of deal set, but I think one that's increasing in the future. With respect to the risk-return profile of the deals flow that we looked at, about 2/3 to 3/4 are in core, which is exactly what you all are shooting for. And so there's, again, a lot of activity, but there's an awful lot of people, institutional capital, as well as sovereign wealth funds and players of all sizes and scales really going for that kind of flow. We've also reported on North America. You all are a global investor, but North America is an important part of source of deals for you all. We've got a table here in our letter to you, and I would draw your attention down to the last row in terms of the percent of total dollars that we're showing in each of a couple sectors: midstream, renewable power, and transport. All of those, as I mentioned a little bit earlier, are, as far as globally in North America, these are meaningful segments. If you look at also just the second to the last line, the average deal ranging from 260 in renewables up to 900 in power, I think reflects the kind of assets those are and the kinds of deals that are accomplished. Just a particular note on renewables, those tend to be smaller projects. It's a lot easier to do smaller scale in that space than it is the others, and so that's one of the reasons why that number is different. If you look at the total numbers of deals, you can see that there's over 6,000, and so it's not really a reflection on lack of activity, just that the projects are a lot smaller. We look at California for you all, and there's certainly a significant amount of activity here. There were 37 deals reported in the database that we were looking at. A significant number of them, more than half, were in the renewable space, either solar or wind, with a couple deals in midstream power, two airports, and some waste. We've provided a little bit of information on some of the deals that we made note of. These are just offered for to be informative on the market and not indicative of what CalPERS necessarily did or didn't go after. With respect to fundraising and dry powder, as I mentioned at the outset, and as you heard earlier for the real estate asset class, there are record levels of dry powder in the infrastructure space globally, and it looks like 2018 is on track to hit a new high in terms of new funds closing on capital. One thing of note, which will contribute to the data in a forthcoming period, is that the two largest funds that closed 2 years ago are already coming back to market with numbers greater than they were before. And so we're probably looking in a year or two at another 20 to 40 or even more, adding on, not even counting all of the other players in the space. So the assets that you all are trying to acquire in the infrastructure space are very competitive, and to get quality core at the scale that you all are looking for. CalPERS has tremendous visibility on the deal flow. We get a chance to see what you all are seeing, and so I think you should be confident that your staff is really able to see so much of what's out there, especially what would be important for them in the kind of assets and the kind of attributes that they're looking for. CalPERS certainly has some competitive advantages in the space: the size, the reputation, and the ability and history of partnering both with other investors, with managers, with strategics. And so even though it's been a little bit of a grind to make that 1.2% inch up, it does seem that you all are doing everything that you can within the confines of having CalPERS be disciplined and careful about the kinds of investments that you're making and the kinds of partners that you're engaging with. So I will end my remarks there.
And I'll just add one more remark, because I think it is remarkable. When you started this asset class 10 years ago, expectations were that the asset class would return 7 to 8% at that time. So a 14% annual return over the last 10 years is truly beyond what anyone's expectations would have been at the time. Part of that is fantastic execution by your staff over that time. But there have been two significant tailwinds just to bear in mind. One, you've had declining and persistently low long-term interest rates, which have partly driven investors towards this asset class. And you've had just a continuation of significant amounts of capital from global pension plans and sovereign wealth funds that are looking for very long-term contracted income that you find in infrastructure, and that's really pushed up the prices. So just to reiterate Lisa's points, the historical returns are great, but what they do is they suppress forward-looking returns in the asset class, so that'll be a continuing challenge for staff as they deploy capital in the future. And that concludes our report.
Okay, thank you. Mrs. Mather.
Thank you. Just sort of along the same lines of the question I asked earlier of the CalPERS team, what would it take for us to really help create the supply out there? Can we have an influence on the supply out there through advocacy or other mechanisms? And what do you think it would take for us to be able to increase that supply in such a fashion that we could increase our allocation?
The supply side's always challenging, because I think a lot of it, as Ted and others highlighted, does relate to public policy. So I think if there's a desire to increase the supply, it has to kind of start with that and a focus on that. And perhaps with the hope that the federal government leads the way in allowing pension plans to invest in more and more infrastructure over time.
Okay,
Okay,
thanks.
thank you. Okay, so no further questions on this item, and I want to thank all of the consultants for your presentation and the updated information you've provided to the committee. So now we will move on to the next item on the agenda, 8C.
Great, thank you, Mr. Chair. 8C, well, Elizabeth and Kit are on our way up. This is an information item, and what we're informing the committee, recommending, is that we delay for 2 years the review of the divestment status of Iran, Sudan, given the sort of recent developments with respect to Iran politically at our federal level and around the globe. That's the short of it. Kit has a presentation about the agenda, but we could stop there if the committee thinks that's the right direction to go in, or Kit is prepared to describe it in more detail.
I see no questions, so it must be the right direction.
Great. Thank you.
Thank you. Okay, let's now move on to item 9A, the Trust Level Portfolio Management Annual Program Review.
And for this one, Eric Baggeson will start us off, and I think he didn't expect that item to go quite so quickly.
Okay, good afternoon. Eric Baggeson, CalPERS staff. As Ted said, we have our annual program review. Let me just do a bit of an introduction on this, I think, and then we'll touch on just a couple of points. And then what I'd really actually encourage the board to do is spend a few minutes of time with the Wilshire review of the TLPM team. This is the first time that Wilshire has actually reviewed the team, so I think that potentially the most interesting information in this is their review of the team. But basically, I think one of the things that you need to understand about TLPM is that this team, most of its activities are very closely aligned with the structure of the investment beliefs and also the portfolio priorities. Most particular, investment belief number 6, that asset allocation is the primary determinant of the outcome to the fund. There's a sub-bullet under number 6 also, though, that relates to the aspirational statement that the organization will attempt to add value with dynamic asset allocation. So a core element of one of the pillars of what this team works on is actually trying to build out a framework by which we will try to understand if that's just a wishful thinking or is that something that can actually be realized. The team TLPM is also very closely associated with the opportunistic program. And you're going to be hearing from Kevin Winter around the opportunistic program a little bit later this afternoon. But that linkage is really because opportunistic does not have a strategic role in the asset allocation. By definition, opportunistic trades are not things that are there on a secular basis or a systematic basis, but rather are sort of episodic, and therefore the opportunities may appear and then disappear. So that kind of activity or that sort of opportunity really does not relate well to having a strategic allocation to opportunistic. But that basically means, though, that when Kevin and his team are able to identify an opportunity in the marketplace, we need to have a mechanism or a process by which we would identify capital that could be deployed into that opportunity. And that's where TLPM comes in. So we've been working to build out a framework to do that assessment and really try to identify where we could source capital into the opportunities that Kevin and his team are able to identify. I think another thing that is important to understand around TLPM also is that a central activity of this team is basically to foster collaboration. Most importantly, or at least primarily, that collaboration really needs to exist across the investment office. So this is a team that really thinks about everything that we do from the perspective of the total fund in contrast to a perspective of, let's say, public equities or real estate or fixed income. So basically, one of our charges is to try to identify skill and knowledge that exists within the other parts of the organization and bring that together. But that collaboration also extends beyond the investment office. We do a tremendous amount of work with the actuarial staff under Scott Tarando. We do a lot of work with the finance staff. We'll have a new chief financial officer coming into the organization in the not-too-distant future. So all of that work and coordination basically is a central element to the things that the people in this team basically bring forward on behalf of the organization. And that was most recently evidenced in the work around the strategic asset allocation related to the PERF and also the affiliate funds. Let's see, I think I'm just going to touch on one or two slides. Slide number 3 in the materials is a restatement of the attribution slide that Elizabeth presented for the total fund in the total fund review. The areas that TLPM is associated with on this, you can see that sort of light gray box in the middle of the top section. There's 4 line items. You have the external MAC program, completion overlay, volatility harvesting, risk mitigation. These are all places where TLPM is actually in the business of deploying some capital into the marketplace. That capital right now is pretty limited. It's about 1% of the fund, maybe a little bit less than that at this stage of the game. But these are places where we're, in essence, really trying to explore alternatives in an effort to understand whether we can do things from the area of risk mitigation or around the actual management of the asset allocation, including dynamic asset allocation. So if you recall, for you, the board members that were here when Joe Deere was our chief investment officer, Joe started the MAC program with the effort to, one, understand whether any external organizations could better manage our strategic asset allocation than we had actually been doing, and also, 2, to understand whether or not there was any techniques or knowledge that those managers could impart into the staff that would expand our capabilities. With Joe's passing, that program became a little bit of an orphan, and when Ted became the chief investment officer, we said we would absorb that into what was at that time asset allocation and risk management in an effort to try to keep that agenda going forward and really to focus on that sub-bullet under investment belief number 6 around dynamic asset allocation. Because at some point in time, as an organization, we either need to find a way to successfully do and scale up that effort around dynamic asset allocation, or if we determine that we actually can't do that, we need to remove that as an investment belief. Because having a belief that invites active management, if ultimately it's proven that we can't do that and may really systematically make money at it, then we're better off to, in essence, remove that temptation to invite that kind of activity into the plan. So that's a big piece of what we're doing in this. When you get into volatility harvesting, that's an area that we inherited, in essence, from global equity. That's a project where we are attempting to, when we say harvest volatility, it's actually just basically selling volatility, and that happens through the utilization of options. And that began in global equity and has migrated into TLPM, and we think that it could be a component part of the risk mitigation effort. And the risk mitigation effort is an effort where we are actually not automatically trying to earn year in and year out a systematic return from the market. In contrast, that's actually an exercise where we basically are paying the equivalent of an insurance premium and are hopeful that if we have certain conditions met in the marketplace, that will be an episodic moment when we would actually earn money on that effort. But that is an effort that will, in essence, actually cost on a pretty systematic basis with very infrequent, very episodic potential to pay off. So that's very different than exposing the plan on a systematic basis to risk premia that we think carries with them sort of a systematic return. When you look at this chart, the places that TLPM touch are that big gray box, and you can see that the net effect for the 1-year period of that big gray box basically was a cost of 3 basis points to the fund, partly due to the performance of the MAC program and partly due to the costs attached to the risk mitigation effort. On a 5-year basis, that big gray box added up to a single basis point. And even though basis points don't sound like a lot of money, a basis point to this fund represents about $35 million. So it's serious money, even with very tiny percentages. The other places where TLPM touches this chart are on the other plan level, which tends to be things such as transition accounts, usually attached to asset allocation shifts. So the numbers roll through that, and you can see that that was a negative 1 basis point for the 1-year period and a positive 3 basis points for 5 years. The other place where we touch are the allocation management line. That's very much directly that whole dynamic asset allocation effort. And we've got a huge, I shouldn't say huge, but we have a significant effort made up of a cross-functional team within INVO working on this whole issue of dynamic asset allocation. That happens to have been positive for both of these time periods. And then another area that we touch is the performance of the public proxies. And that is related to both the misweights attached to the private assets, which do not have the ability to absorb or to pay back capital on demand. So it's hard to manage the exposure to those private asset classes. When you're under-invested in something like private equity, by default, you are over-invested in something else. The money is deployed someplace else within the portfolio. So this relates to that sort of implied proxy allocation that accounts for any under or overweight to the private asset classes. But it also links back to the overlay program that we're attempting to build, which seeks to create a version of the total fund asset allocation, which can be executed just within publicly traded markets, which then allows us to then control those allocations. So there's a large effort going on to try to understand how effectively we are or are not able to proxy the performance of the private assets through publicly traded instruments. And that's where that whole sort of overlay activity falls into the program. When you add up all of these pluses and minuses, small numbers of basis points, TLPM had a positive 4 basis point effect for the 1-year period and exactly a 0 effect over the 5-year period. I think the last page that I would speak to in the review, and there's a whole bunch of other slides attached to the appendix that we'd be happy to answer questions about, but not necessarily try to present information about it. But it's mainly just about the accomplishments and the upcoming activities. So in the 17-18 fiscal year, we went through the strategic asset allocation for the PERF. We've also gotten through all the affiliate funds. That took a huge amount of work and coordination by the team. We've also done a lot of work in relation to the MAC program. And at some stage of the game, we'll probably bring back a review specific just about MAC. I think that's a topic, the media has picked up on this agenda item and is certainly writing some articles about these efforts. But one of the things that we've done with the MAC program is to add some additional managers to the roster. So we were basically allowed to have a total of 6 managers under Ted's manager constraints, basically. We're using 4 of those manager slots to really work on the multi-asset class activity, and 2 of those slots to work on the risk mitigation activity. So that whole program has been fleshed out over the last year. And we've also been working to restructure some of the mandates around MAC to basically bring that program much closer to the asset classes, the risk constraints, the ranges that are applied in the structure of our strategic asset allocation. We believe that the greatest potential to try to create some knowledge transfer from external entities is to have them working on something that is very close to what we were actually able to work on. When Joe Deere originally built this program, he made it unconstrained, so the managers could use any kind of definition of market segments or asset classes. They were also able to use things like leverage beyond the capacity that we have with our current policy limits and things of that nature. So we're in essence restructuring some of that to, not in every instance, but in some instances, rein in some of those degrees of freedom and make it more reflective of the things that we can actually do. And then we've got the 18-19 initiatives. One of our initiatives, as Ted mentioned, is to actually really sort through this whole issue of active risk and really try to create more attribution so we can understand whether we're adding value in that area or not. To continue the work on the dynamic asset allocation efforts that are there. And to really continue to explore the topics in particular that were brought up earlier today around currency, inflation. We owe you a return with information on those topic areas, and I think we're going to try to bring that to fruition over this fiscal year so we can actually have a understanding about what is the most rational approach for the organization to take in those areas. So I think with that, I would stop blathering at you. Happy to answer any questions and move this on to Wilshire's part of the assessment.
Okay. Yeah, before I call on the committee members, I just want to applaud you, the staff, for the accomplishments that are listed here that talks about our asset liability management, excuse me, and strengthening the long-term sustainability of the fund because a number of steps have been taken, including the ones listed here, but there are some others that you've accomplished, such as the amortization rate changes, all those steps that you've taken to have the long-term sustainability of this fund. So I just want to applaud the staff for the actions that you've taken. So thank you. Ms. Mather.
Thank you. Well, I think this program is really essential as we try to really look at things holistically across the total fund, be making the right trade-offs within the portfolio, and the right decisions around both risk and return. So I think really important work here. I do have a couple of questions. The risk on page 3, that chart. The risk mitigation that you have listed here is not the same as our risk mitigation policy. It's not to effectuate the risk mitigation policy. It's a different type of risk mitigation. Could you delve a little deeper into what that means? You
Sure.
gave a quick answer, but if you could delve a little bit deeper.
No, you're absolutely correct. It has nothing to do with the risk mitigation policy that you as a board have adopted. This is actually trying to understand dimensions by which we end up with some kind of an impairment of our asset values. So like a big downfall in the public equity markets is indicative of that. So we're looking at those dimensions that have that potential to create that impairment and asking ourselves, is there a way to effectively hedge against that activity? So that's really what it's targeted on. There'll be more information coming out over the coming year, basically, about this to you as board members, and there's more that we can actually say in closed session
Sure.
about it if you want to have more discussion there.
Okay, thank you. And then with respect to the public proxy performance, we had talked at some length, I think it was maybe a year ago at the offsite, might be been a little longer, about the use of leverage at the total fund level. Is this partly where that would be effectuated if we were to implement that, and are you?
It could be.
Yeah.
So, for example, one of the areas that we're trying to come up with some proxy assets, and this involves work between the TLPM team and the opportunistic team headed by Kevin Winter, is to find a mechanism to try to proxy, let's say, the return expectations for private equity. Now, we do not ever believe that we'll actually be able to proxy the outcome of private equity, but our return expectation is public markets returns plus 150 basis points. So that leverage could, for example, be a tool to attempt to try to do that. It could also be taking some incremental other type of a risk, such as a credit risk or something of that nature, basically in order to try to generate that return. So all of that will dovetail together.
So it's not, and is it just looking at the return, or is it also looking at some of sort of the fundamental characteristics of that particular asset type?
What we're trying, so the existing public proxies are simply just where does the capital get deployed to if it's not in, let's say, private equity or real estate?
Right.
Because we've tended to have an underweight to those two areas pretty systematically. So there's that implied proxy that is not necessarily a conscious decision of anybody other than just leaving the money sitting in some part of the portfolio. Then there's the intentional work to try to define proxies that have more efficacy. The basis of trying to define those proxies is actually the benchmark returns and the capital market assumptions, basically, that are attached to these different parts of the portfolio. So when you think about things like private equity and real estate, you've got the appraisal process, you've got lags, you've got all kinds of things that affect the actual outcome. We're not trying to proxy those elements. We're just simply trying to proxy the attributes that went into the strategic asset allocation that have caused us to allocate money to those parts of the portfolio.
I see. Okay, thank you. That's really helpful.
Okay, see no further questions. Thank you. Next.
Great. Good afternoon. Tom Tote with Wilshire Associates to cover the opinion letter on our TLPM review. You'll recognize the framework from some of the other internal programs which we provide a similar review on. And the real purpose is to give you an idea on the due diligence that we would do for we'll call it a typical investment management organization, and looking at the important facets which we think have a strong ability to predict success in terms of adding value. So you've seen it for global equity, you've seen it for global fixed income, and now we're doing it for TLPM, and you'll hear shortly also on the opportunistic strategies group. So rather than walk through the opinion letter, I'm certainly open for questions. I thought I'd just start with a couple of comments, first on the strengths that we see in the program, opportunities for adding value to the total fund, and then some areas for monitoring, potential areas for improvement as well. So starting with strengths, and Eric touched on this, I think the strategic asset allocation process and the coordination thereof is a real strength of the TLPM group. And having just gone through that, you've really seen that in real time. It's very robust, and it utilizes input from consultants, outside experts, from the board, from staff across the organization to really triangulate on a portfolio that helps you meet your objectives. And at the end of the day, that's the single most important determinant of the success of the CalPERS investment program. Further, the TLPM team has significant experience and depth given their current mandate. We would expect some fluctuation in that as things are built out over time, but given where they currently stand, we feel like those resources are sufficient for their mandate. In our discussion with them, and one of the key due diligence processes is coming on site to sit with the team, and not just sitting with Eric, although that's very important, but also talking to the AIMs and the IOs and getting a sense, a very holistic sense for how the process is working. And in those discussions, we came away very comfortable that expertise, the appropriate level of expertise, sits within the TLPM team. And that comes with a very strong understanding of portfolio construction. We talked a little bit about active risk exposures. It's very clear to us that the team is very cognizant of those and is going to be very judicious at using those levers in terms of managing the TLPM process. And then lastly, on the strengths, the research collaboration really came through in our discussions and our review of materials, and trying to make sure that all of the various information sources are utilized not just within TLPM, but are also broadly disseminated and widely available to staff as necessary to make good decisions. So we were very favorably impressed with that. In terms of opportunities, Eric touched on this a little bit in his comments. We'd like to see continued improvement in cross-asset collaboration. I think CalPERS has made significant strides in that area, and the way that we're viewing TLPM is very much a focal point for those decisions. So continued improvement there represents a real opportunity to add value over and above the portfolio's strategic benchmark. Those can include things like the strategic overlay program, rebalancing decisions, whether to fully rebalance or partially or not to rebalance, as the case may be, based on very well-researched and well-founded principles. We are also very positive on the continued build out of the attribution capabilities. You've seen a little bit of the results there, but at the end of the day, it's very important to make sure things are appropriately measured, because then they get managed, and to understand whether the decisions that are being made on an active basis are really adding value relative to the policy benchmark. And Eric also touched on this, but the external relationships, we think there's significant opportunity there for both learning and for adding value to the plan. And the changes to align those external relationships with the policy priorities to do things like mitigate drawdowns and manage total fund volatility, we look at very positively. When you look at our scoring, and this dovetails in with the areas for improvement or continued monitoring, a couple of things jump out, and the first one being a below average score for the organization, and that really is driven by turnover at the senior investment level. With continued stability, we imagine that our score there has the potential to increase, but that loss of intellectual capital is a real threat to the organization, and I think the board is well aware and making strides to manage that, but we think at this point there certainly is room for improvement there. And then you'll also notice in our scoring that the forecasting score comes in as average. You saw a little bit of the attribution there, slight negative. Ideally, for a strong forecasting score, we want to see sort of proof of the efficacy of the TLPM program. And given that it's still relatively early in the life cycle of the program, we think there's room to improve there as well. And so we rated that as average currently. Our expectation, as that's built out, as the track record is developed, and as the levers that they pull start to add value, that score will increase. So in summary, I think it's fair to say that we view the growth and the evolution of the TLPM program in a positive manner. We feel there's real opportunity to add value over and above the policy portfolio, given the team's level of expertise, and it aligns very well with the overall CalPERS objective to meet your return hurdle at a reasonable level of risk. So with that, I'll stop and stand for questions from the board.
Okay, I see no questions on this item, so
Great.
thank you for the report.
Thank you.
And so you up next also, Tom, I think.
Actually, I think we'll hear from staff first,
Oh,
right, and then the consultant. That's how we prepared, so you don't want to throw us off kilter here at the last minute.
just keep moving ahead.
So I think Kevin will be kicking you off once you get here.
Right, your mic.
There we go. Pushing the wrong button. As this is the inaugural opportunistic presentation, I thought I'd give you guys sort of an outline of what the group looks like and what we do, and then open it up to questions after that. So really, opportunistic is 3 different business segments. The first is trading, the second is beta enhancement reinvestment, and the final is the actual opportunistic portion. Looking at ESS, this group does most of the trading for the fund. They currently trade for TLPM, GE, GFI, and we do some one-off trades for the private asset classes. Recently, we did a trade, currency trade for our real estate group, so we're sort of collaborating with most of the groups within the fund. The only person group we haven't worked with this year is private equity, but historically, the GE group also traded for them when they had IPOs or something like that. So, as Eric mentioned earlier, collaboration, ESS is probably the most collaborative group within or one of the more collaborative groups within the organization. ESS
Excuse me, Kevin,
really...
could you get closer to the mic? Could you
Okay,
get closer?
sure.
Okay.
ESS basically came together as it is in its current form last October when the GFI trading team came over to ESS. Since that time, we've put together some SLAs with each of our customers. We view all the asset classes as customers, and we're providing a service to them. So the SLAs, or security level agreements, give a clear outline of what we're responsible for, what kind of workload there is. And if there are changes, we have a quarterly meeting and we say, okay, we're noticing a huge increase in volume, we might need more resources here or something like that. So it's a very collaborative interaction with our customers. Another point about ESS I want to clarify is almost all derivatives that are within the fund are traded on the desk. Wiley Tollett, who was our previous CIO, was really, really adamant about having all derivatives in one place so we could really track that risk, because things get really out of whack really quickly with those types of securities. An additional aspect of ESS is we're trying to build redundancy within our trading group. So we have a number of people that were equity focused, a number of people that are fixed income focused. We're trying to get those to sort of go across so we have more depth in our trading desk, so we're not dependent on 1 or 2 people to trade a certain types of security. We have more people there to do that. And finally, an interesting part of this integration is recently we were able to do a trade in the fixed income area that uses methodologies that the equity side traded with. It resulted in really, really good execution. The PMs in the fixed income group were very, very happy. And this is like one real big win for the ESS team. Final thing that ESS also works on is sec lending. They do all the sec lending for the total fund. Next, I'm going to move to beta enhancement. Beta enhancement currently is a value add for GE and GFI. We basically, they'll gain the beta exposure via the futures market, which frees up some cash. We'll invest that cash in LIBOR-based securities. These securities are very low risk from the standpoint of capital loss. And in this strategy, we have really long-term focus. We'll be able to take ups and downs of market volatility, but over the long term, this one's going to pay off for us. Well, over the next few years, we're going to add additional types of securities to this, and we continue to work on that. The final area that we have is opportunistic. As Eric mentioned earlier, there is no strategic allocation to opportunistic. Funds must be sourced from other areas within the fund. And TLPM has to agree to where we source the funds from. So for example,